The idea that a recession or a slump is going to lower prices and therefore interest rates are going to come down. I know everybody thinks that within the establishment, but it is completely false. But I want to emphasize that we're actually looking at this the wrong way around. It's not gold going up, it's the dollar going down. This has been very much the case with other currencies. While the dollar was strong, as it were, but now that the dollar seems to have turned some sort of corner and is weakening, is the fate now being faced by the dollar as well.
The increase in the spot price of gold to an unprecedented level on December 3rd, 2023, exceeding $2,100 per ounce, captivated the attention of new investors drawn to the distinctive advantages of gold investment. Nevertheless, while gold typically demonstrates long-term stability in value, its short-term price tends to fluctuate significantly, as currently observed. After a recent peak, the spot price of gold has seen its most significant drop in 9 weeks, hovering just above $1,980 per ounce as of December 13th. The price surged by more than 1% following indications from the U.S. Federal Reserve of potentially concluding its interest rate hike cycle and considering future rate cuts. This change is linked to the dollar's decline. After the Federal Reserve's recent meeting, investors observed the dollar heading for its most extensive 2-day decline since July as they adjusted to the revised expectations for U.S. interest rates. The Bloomberg Dollar Spot Index fell by 0.8% on Thursday to its lowest level since August, extending its downward trend following hints from U.S. policymakers about the possibility of monetary easing. Alasdair Macleod underscores the increasingly precarious situation in the paper markets, especially concerning bullion banks and their short positions. Typically, producers offset these positions. However, the current absence of hedging leaves swaps to navigate the market's fluctuations independently. This imbalance and heightened buying interest as the gold price approached $2,000 necessitated a correction to eliminate speculative investors. Alasdair stresses that rather than merely interpreting gold's ascent, it's crucial to acknowledge the dollar's decline. This shift in perspective aids in comprehending why gold might achieve higher values. It's more reflective of the weakening dollar than solely indicative of gold's inherent strength. As trust in currencies, fundamentally established on credit, diminishes, coupled with the substantial deficit the U.S. government is running, the potential for a significant decline in the dollar's purchasing power becomes apparent. Alasdair sees that this scenario could propel the gold price significantly higher, potentially surpassing figures like $2,300 or $2,500 due to the dollar's devaluation. We'll share clips from Alasdair Macleod's interview with Liberty and Finance. But before that, if you'd like more videos, please subscribe and turn on the notification bell for updates. Thank you, and enjoy the video.
And if you put it in the context of the paper markets, remember that the bullion banks and other members of the swap category on COMEX basically run short positions. Their short position was increasing very rapidly, and they had the further problem that normally there would also be producers running hedging positions in the market. So, but they're not. I mean, the level of hedging is as low as it's been in a long, long time. So the result is that the swaps are having to deal with the bulls in the market on their own, and for them it's a potentially dangerous situation. I mean, quite obviously, as soon as it was going to go through 2000, you could see that everybody, hedge funds and all, the momentum chasers and all the rest of it, they were going to go in there and buy it. Of course they were. So they needed shaking out. And it's if you like, a normal process. As you rightly say, nothing goes up in a straight line. But having said that, in my market report for Gold Money last week, I suggested that it would be perfectly normal for the gold price to tick back to around about 1950, which is where the long-term moving average was. And on that basis, that, if you like, would be the platform for gold to really start moving ahead. But I want to emphasize that we're actually looking at this the wrong way around. It's not gold going up, it's the dollar going down. This has been very much the case with other currencies, while the dollar was strong, as it were. But now that the dollar seems to have turned some sort of corner and is weakening, is the fate now being faced by the dollar as well. And I think to put it in context, people might find it a little difficult to imagine why gold should run to, say, I don't know, let's pick a figure, 2,300, maybe 2,500 or something like that. Or talking about some sort of reset. But I think the right way to look at it, which would explain everything for people who can understand this, it's not gold rising, it's the dollar falling. So if you turn the price upside down and think in terms of what's going on in the dollar, not gold, you can begin to understand the circumstances whereby the dollar rapidly loses purchasing power, which would be reflected in the gold price. And then, if you talk about the dollar maybe losing a quarter or a third of its purchasing power, I mean, the conditions are there for that to happen, even before foreigners intervene and decide to dump the dollar. You can begin to understand why the gold price, if you like, would reflect this at a far higher level. And I think what's developing in fiat currencies is actually just that situation. We're beginning to see these fiat currencies, in other words, credit, which depends on faith in that credit and nothing else, that is beginning to lose credibility. This is probably slightly at odds with the, if you like, the chatter on the street about interest rates and things like that, and how they're going to ease and how we're going to go into recession. So prices aren't, inflation's going to start going back to 2, and you never know, they might have difficulty holding it above 2%. You've got all this sort of chatter, which rather militates against that. But if you actually understand that we're talking about credit, which has no anchor in value, and we're talking about, in the case of the United States, a government which is running a deficit in this year, which I estimate will be probably 3 trillion. It could even be more, because roughly half of that is interest payments. That's got to be financed.
Russia's gold reserves have surged to a historic high, surpassing $150 billion due to the recent spike in gold prices, as reported by RIA Novosti news agency on Thursday. In November alone, Russia's gold investments soared by 2.2% to reach $151.9 billion, according to an analysis of Russian central bank data by RIA Novosti. Alasdair observes that Russia possesses a significant amount of gold across different accounts. While their official reserves are estimated at 2,300 tons, there are speculations that Russia holds an additional estimated 10,000 tons in other state accounts, specifically within precious metals and wealth funds. This puts Russia's gold holdings above the officially declared reserves of the United States, which are currently standing at 8,130 tons. Such an extensive gold reserve could provide substantial backing to Russia. Moreover, even Singapore's central bank ranks as the world's third-largest buyer of gold in 2023's initial 9 months, following the gold acquisition trends of China and Poland, as per the World Gold Council, WGC. Alasdair interprets this as a significant signal indicating the diminishing significance of the dollar, a sentiment echoed by various central banks worldwide in their gold acquisition strategies. Let's get back to the interview.
We put it in the Russian context. Russia has a certain amount of gold. I think her official reserves in the order of 2,300 or something like that. But also, like China, Russia has gold in other state accounts. There are 2 accounts in particular. Sort of one's a specific precious metals fund, and the other is a wealth fund. It is believed, while this hasn't been officially divulged, it's believed that they've got a further 10,000 tons or so in those 2. So that, Russia is in a position where, with its central bank reserves, it can actually mobilize enough gold backing, more gold backing than America declares at 8,130 odd tons. So it can do it. Now, the other thing to bear in mind is that with interest rates in Russia currently around about 15% or something like that, from the point of view of a Russian bank, and they would be steered in this direction, what they could do is they could walk into foreign markets, say in Dubai, buy bullion, where the interest rate on the leasing of bullion is in the order of 2%. I mean, they could just lease bullion if they want, is in the order of 2%. Push it into the central bank of Russia and get 15% on it. Now, that 15% under a gold standard is effectively 15% in gold. So that's why you use interest rates to create the arbitrage to maintain your gold reserves. Russia is in a position where she can do that tomorrow. And indeed, senior economists in Russia have already made this point. So I think that's absolutely clear. Singapore is, I think, very interesting because the Singaporean government has got extremely good intelligence about Asia, about global trade, all these matters. And as a small island state, it's sitting there knowing what's going on in a way in which we can just not really appreciate. The fact that she is accumulating gold, and really quite aggressively, I think gives us a very, very good message that the days of the dollar are effectively numbered. And I think this is being echoed in the gold acquisition policies of other central banks, not all of them, but you can see that how other central banks are deliberately building up their gold reserves. You know, the importance of understanding the difference between credit and money being physical gold with no counterparty risk. Credit always has a counterparty risk. Now, whether that counterparty risk is a commercial bank or whether it is indeed embodied in the currency issued untied from, with no commitment at all to exchange that currency for gold coin or gold bullion, it's irrelevant. We're looking at credit collapsing. And there are two routes in which this can happen. One is that, you just stand back and let the banks all fall over and the economy fall over and all the rest of it. And that destroys the credit. That obviously that's not going to happen. That's not what governments are elected to do. That's not what the central bank's duties are. It has a mandate to oversee the banking system and ensure that it doesn't impart risk into the broader economy. The other way of doing it, of looking at this, is that as banks do get into trouble, as malinvestments begin to be unwound. I mean, I'll just tell you a little story about that in a moment to illustrate the malinvestment thing. But as they're unwound, then it's going to be at the expense of the currency. The currency and bank reserves reflected on the central bank's balance sheet will expand very, very rapidly.
Looking ahead, gold, despite experiencing recent ups and downs driven by signals of changing interest rates and a weakening dollar, might continue its upward trajectory. This potential rise could stem from ongoing uncertainties in currency values and market conditions. What are your thoughts on future price movements of gold and silver? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.